What is up everybody, this is your host Yasin Nizami and welcome back to my channel. In this video we are going to talk about the rising inflation problem in Canada. Why is it happening? What are the reasons and how this can be improved going forward? We are going to touch upon that as well. So without further ado, let's dive in. So Stats Canada published their latest CPI figures for the month of September last week, and it came out as 4.4%, which is the highest since 2003. We haven't seen the rate of inflation that much high since 2003. So the price of goods and services are at the highest level in the last 18 years. Now, for those of you who do not understand the way inflation is measured, basically it is measured by a parameter called CPI, Consumer Price Index. And what it does is it measures the price difference of certain products and goods that a typical Canadian purchase within their daily life, and they compare the change of price from the last year during the same time. So when I say inflation is 4.4%, that means the rate of change of those goods and services is 4.4% higher than last year. So even if the rate of change or inflation drops down to, let's say, 4 or 3.5 or even 2, it does not mean the prices are going down. It means the rate of change of price is decreasing, which means the prices are still going up, but at a lower pace. It's like, if you're driving a car, on a 180 miles an hour speed, and you accelerate the car and drive at, let's say, 250 miles an hour. So your rate of change of speed has gone up, right? But even if you put your foot off the pedal and the car speed drops down to, let's say, 150 miles an hour, you're still going ahead, but at a lower speed. It's same thing. So when I say the inflation is 4.4%, that means it is the difference of price appreciation compared to last year. Now, there are two main reasons why inflation is significantly higher this time around. Number one is the global supply chain issues, and number two is the amount of new money that is being injected into the economy, which is trickling down through the economy and driving the consumer spending, and hence rising the asset prices. So we're going to touch upon these two in detail. First, talk about the global supply chain issue. So the way the governments across the world has responded to this pandemic was not very practical. You cannot just turn on, turn off the global supply chain by flipping a switch, because the global supply chain is a set of complex operations. It has a multi-layer, very complex operation sequences. Even if you disrupt one thing, it actually has a domino effect, and then it disrupts the entire global chain processes. So it's very complex. You cannot just turn on, turn off by flipping up a switch. If you disrupt one thing, it will take its time to get up back into the previous operation level. So which is why we are seeing the disruption across the globe. You might have seen in the news that a lot of shipping container ships, they are actually floating in the West Coast in the Los Angeles Bay Area, where there is not enough staff working at the port to offload the container stuff from those ships. That's another problem that we can talk about. The way the government has responded to this pandemic is they actually created this global supply chain backlog, because when you're paying people not to go to work and then just stay at home, then who's going to go back to work for 11, 13, 14 and $15 an hour job? They will just stay home and then chill out, right? So because of the pandemic response by these governments, where they provided stimulus checks and all sorts of funding to people just to stay home, it is creating this massive lack of workers across those industries. And we can see, this will have also a domino effect, where you cannot just bring those employees back to the room the next day. It's going to take time. And then by the time, those workers go back to their workplaces, they will have a massive backlog of requests and workloads to fulfill. So this global supply chain issue is going to stay because it is massively disrupted, and it's going to take some time before it goes back to its pre-pandemic level of operation. that's one thing, and I think this will continue to contribute into rising goods and services prices. On the other hand, the other issue is the amount of liquidity that is being injected into the economy. So the way the government responded to this pandemic issue is they started, first of all, they dropped the interest rate to the bottom. Okay, so they dropped the interest rate to the almost zero level, and then they start creating money, the new money, by printing more dollars or more pounds or all sorts of other currencies, and then injecting into the economy. So when the new money is injected into the economy, that increased the purchasing power of an average person, average Canadian, average American, wherever you are. So when you have the new purchasing power, which is not generated by working more hours or by producing more goods and services, it just came out of nothing, then ultimately this will drive the asset prices up. So it drives the consumer behavior in terms of spending that money. And what we have seen recently, that money is being spent in terms of buying real estate properties and investing into stock market, Bitcoin, that stuff. So we are seeing that asset prices are accelerating at a very higher pace in the last 18 and 24 months. Real estate is another issue where the interest rates are so low. When the interest rates are so cheap, that means the borrowing of the money is very easy and pretty much free. So people will start borrowing more money and putting into assets like real estate, which is of course one of the reasons why we are seeing price appreciation across the country. So these are the two reasons where we are seeing the rising inflation is becoming a non-temporary issue, where this issue is going to stay for quite some time. And all the big economists and our chief of Bank of Canada has been keeping this narrative that hey, inflation is transitory. It is because of the disrupted global supply chain. After some time, this will resolve, and then the inflation will come back to its previous level. I don't think this is as easy as they're making it look like, because the global supply chain is a complex issue. It's going to take some time before it goes back to its previous level. But the other issue that they're not talking about is the increase of liquidity that they have been printing new money since March 2020, and to this day they're still printing $2 billion per week in Canada, which is contributing towards rising the asset prices. So a lot of critics are basically pushing Bank of Canada to increase the interest rate. Now, rising the interest rate is one theoretical solution to control the rising inflation, but it will not solve the global supply chain issue that I pointed out earlier, because that has its own, intricacies, its own processes that has no impact or very little impact in terms of the interest rate. But certainly rising interest rate will actually make the debt more expensive. When the interest rate goes up, borrowing new money becomes very difficult and expensive. This will not only make the household life difficult, because the average household in Canada has taken a lot of debt, whether buying new car or real estate, or stretching themselves too much to take more loan and purchasing new stuff. But more so at the government, at the corporate level, where they have taken a lot of fiscal debt in order to do the overspending, those corporations and our own government will be at a risk of getting default to its. Even if it doesn't get default, then a lot of their revenue or income is going to be spent to service the debt that they have taken. If you look at the global debt right now, it is at a highest level historically, 300 and something trillion dollars. And Canadian government itself has taken a lot of debt in the last 18 to 24 months. Imagine if the interest rate goes up, how these corporations, these governments will be able to service their debt, because a lot of their income or revenue or tax collection will be spent in servicing the debt in terms of paying interest payments. And which means, when you spend too much money in terms of servicing the debt, that means you're spending less money in welfare, less money in education or healthcare or other business initiatives, which ultimately means it will shrink potentially the GDP growth and will shrink the economy going forward. So there is a bit of a risk involved here. As the interest rate goes up, not only is it going to impact the household from getting default perspective, but also it is going to impact the government spending because when they start spending more money to service the debt, which means they will spend less money in other projects and ultimately will lead to weaker economic growth. So it's very complex subject. I think a lot of people who are calling for hiking the rates do not really understand, or they're not maybe openly saying that this is going to impact these things, but they're just making people feel that hey, the interest rate is going up, so hold down, don't spend too much, or don't stretch yourself too much by borrowing too much money and buying cars and real estate properties. So we will see next week. I think Bank of Canada is going to announce their monetary policy, and we'll see what kind of statement they will come up with. But in my opinion, I think it's very difficult to increase the interest rate at this stage where the economy is still struggling, and a rising interest rate will do more damage than good, because it is not just about real estate prices, it is about the entire economy in country. So I hope this is helpful. If you like it, give me a thumbs up and hit subscribe, and I will see you in my next week video. Take care.